All right, calls of the day. We start with Amex. Initiated overweight at Barclays, the target 184. Carrie, you're first up on that. You own it.
Yeah, well, that's a very cheap stock. You know, it's underperformed. It's been a tough market all year for financials, and we need to see a little bit of consumer positivity, which we are questioning. But on the other hand, American Express, great company, building up the franchise in millennials and younger people with money, and we think at this price, you can't go wrong.
They say, quote, we see the most compelling value in AXP and rate the shares overweight. Bears will argue the company's 10% plus revenue growth target for 24 could be at risk. They think they're achievable.
Well, one of the reasons why we added American Express back in July to the ETF was based on revenue growth. So over 36 months, the average revenue growth is 7%. This is a company that was benefiting from reopening from the travel enthusiasm globally and saw its revenue growth over 8 quarters grow to 26% and over 4 quarters grow to 20%. The issue that I have and the concern that I have, and we still own it, is why there's been the deterioration in price since July. Is that pricing in what we talked about at the top of the show, which is that the economy and the consumer is ultimately going to weaken, which they are right now? Is that what American Express was reflecting in the price action in the last 3 months? That's a concern I have.
The wealthy are still traveling. I mean, you're still getting the American Express cardholder are still traveling and still spending money.
So the answer is yes. And what you saw was you saw all the credit card companies kind of come down in tandem. But then once you parse through that, what's really interesting is American Express services a higher end consumer. And so as we're debating this, right, as we're duking it out over the health of the consumer, the reality is the consumer is wildly bifurcated too. Yeah, so at American Express, for example, you have 1.2% 30-day delinquency pluses in their credit cards. At Discover, that number is 3.4%. So American Express, even though they're down with their peers, their business is in much, much better shape. One thing here too, you've got mid to high teens growth, you've got a 12.8 times multiple. Again, like I think this is where you want to be. Growth exceeds the multiple.
Okay, let's switch to Bristol Myers on the other end of the table as well. Downgraded to neutral at Cantor. Getting out of this value trap. That's the language they use. Jim, you have this one first, and then Jenny, but you go first.
Yeah, let me speak unemotionally, just factually. Over the last year, the forward multiple on Bristol Myers has gone from 10 to 7. Both numbers are very low, but why is it? Why has it gone down by 30%? I think it's very simple, and it's also writ at most of the other pharmaceutical companies, except for the GLP-1 producers. The reason is the Inflation Reduction Act from last year and the introduction of drug pricing from the Centers of Medicare Services, which in the first 10 drugs that are being negotiated included Eliquis, a Bristol Myers Squibb's drug. Now, I'm explaining why the multiple has gone down, and I think that's the reason, but there is still fundamental value here. This stock's been a dog. I mean, let me not walk away from that. It has been an absolute dog. It still sports a 4.5% dividend yield. It's got an excellent oncology business, and people are not getting younger. They're getting older in the world. They're going to need more drugs, including the life-saving drugs that Bristol.
Some of us.
Fountain of youth.
This conversation is making me get old, I'll tell you that much.
Easy where you tread, my friend. Jenny, you have it too, presumably for that 4% yield.
4.6. And in a lot of ways, this reminds me of our investment in AbbVie several years ago, where the portfolio wasn't looking great, but they were generating unbelievable free cash flow. And the idea was, who knows what they're going to use that free cash flow to do, but they're likely to buy their way out of the mess they're in. So they're going to generate $75 billion of free cash flow over the next 5 years, 4.6% yield, 6 times earnings. One of the things that bugs me is that the analysts are like saying sell now. I'm like, okay, so you all wanted to buy it, or at least some of you wanted to buy it 30% ago, and now you have a problem. But even with this downgrade, the downgrade now, the downgrade in target still has a $55 target. So you've got 10% upside if they're right, plus a 4.6% yield. The thing's already beat down to death. You know, we're probably at a bottom here.